Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, October 11th, 2017. I wanted to go over a few things that I'm watching today. This is CL, Crude Futures. In yesterday's update, I mentioned this resistance level here, former resistance at 50.78, called 50.80-ish. We've had quite a few little pierces up through there, so roughly 50.80. I was expecting crude to turn down there, at least pointed that out as a significant resistance level. And then I also followed up with a post on the site, or I can't recall if it was in that video that I said if we do pop through there, there's a possibility we head on up to this 5120 level. And the reason for that, as you can see here, there's been a couple pierces through there already. And you can see the reactions up here from above, quite a few, then a very impulsive sell-off. So this is a level, so far we failed. We tried to attempt to go through there, failed, came back. Now we're flirting with that 50-80ish level again. So this is an important level for crude futures. If we fail that with conviction, we're going to come back down and we'll probably come all the way back in here to the 49. I have it at 49.78, roughly 49.80 level on crude futures. So something to watch for. Also note here we have a bearish crossover on the PPO or the MACD in this case. And a high level crossover at that. Last time we had a bearish crossover was right here, right about where that circle is. So you can see we had a bearish crossover and it was followed by this, sharp correction here. Sometimes you get a crossover like we had right here, bearish cross right there. We pushed up, made a marginal new high, but then we had this whole correction down there. So something to watch out for, because a MACD is a momentum indicator, and although it's a very simple sell signal, it's fairly effective. Just look at bearish crossovers and bullish crossovers for that matter. Like we had a bullish crossover here, so that's what I'm looking at. But again, as I often say, support is support until and unless broken. This was a former resistance level. Once resistance is broken, it becomes support. So here's the battleground. Now, interesting to note, crude had a big rally yesterday. I can't remember exactly what crude futures were up. I think it was over 2%, if I'm not mistaken. And it actually, crude steadily rose throughout the day. But I pointed this out in the trading room yesterday that we'll go to XOP. We'll go to 1 minute chart. Um, XOP, which is the oil and gas exploration and production ETF, had a big pop at the open and went as high as about over 1.5% up here at the highs. And throughout the day, those gains were slowly and steadily and consistently faded till we went negative. Actually, there's a close. So we faded all the gap and then some yesterday. In other words, the energy stocks were not buying that rallying crude. So does that say something? I always say one day doesn't make a trend, but it's that's I've been making the case, that I'm expecting more downside in the energy stocks, and so far that's a pretty bearish sign that they didn't follow crude's lead up yesterday, and you're seeing this is today more downside. We popped at the open. Another positive open, gap up, and another gap fade to take us negative again. So, not exactly a bullish price action for the energy stocks, and that's XOP. A little more juice. I like to trade XOP. It depends on the charts, of course, but XLE has a lot of overlap. XOM, ExxonMobil, Chevron, they're both in both of these ETFs, but same story. You can see a big gap up, about a gain of over 1% in XLE yesterday. Again, that's the opening gap yesterday, and those gains were consistently faded throughout the day to backfill the gap and then some. Same story. Popped at the open and so far faded. So energy stocks are still looking near-term bearish to me. There's XLE, that 60-minute chart that I covered, failed right up at that previous reaction high, moved down, and I could add another line here. You might want to watch that if you're an active trader. There's support you can see right here, and I'll give you that level in case you want to watch it. 67.87 roughly. So watch for a break and a 60-minute close below 67.87, and for a continued move down. XOP, we've already went over this. I've been covering this quite a bit lately. Broke down from the rising wedge, hit the first target zone, bounced up, had numerous failures here about the 3450 area. And so that T1 zone is still, it was a target zone. It was already hit once. It's still a support zone. Those are two close, two support levels in close proximity. So if you see a break at the bottom of the zone, especially with a 60-minute close or some impulsive selling after the break, that's probably going to take us down to the second target here at 3230. Trend indicators are clearly bearish, as I think I pointed out yesterday. So that's something else to help affirm the case right now. It's not, since it's a counter trend trade, still not an official trade, but I know a couple of you have mentioned in the trading room that you're short the energy stock. So that's what you need to look for. And of course, if we pop above those new highs, especially with convictions, trend indicators go back bullish, that may be it. That may be all we needed for a correction. But as of now, near-term outlook, it remains bearish. This is Nvidia. Now, I'm just covering this. I wanted to make mention that it was stopped out yesterday. The stop on Nvidia was any move above 191, so they did clip our stop yesterday. Closed back below there, but I had that one on any move above 191. Sometimes I'll set a stop on a closing basis. I just want to let you know, for those following this stock or even still in it, I've modified this trend line right here, the uptrend line. When we shorted it, it was after that island cluster top, and the trend line grabbed these reactions here. Since that island cluster top, which didn't play out, we came down, we hit this support line right here, about 170.52, and we bounced. So therefore, I have to modify this trend line to capture these candles right here, and that's now the uptrend line to watch. So nothing's really changed in the bigger picture. And I wanted to say this: I would take this trade over and over again the next 20, the next 100 times in a row. I've been trading many years. Island cluster tops are not only one of the most um, reliable chart patterns that I've traded in the past, meaning the success ratio. It's hard to quantify it. It does depend on market conditions, but I would want to say maybe 70% or better. And more importantly, it's such a, when you see island cluster tops or bottoms for that matter, those are bullish. The percentage gains are very large because they tend to mark significant tops, not just little pullbacks within an uptrend. That happened to be the case here. Now, part of that, and a large part of this, is the fact semis are still, well above their uptrend line. I thought they might break. I knew that, going into this trade, but again, we don't get many of these. Are pretty rare, especially clean like that. And most importantly, is the risk reward is well worth it. We were stopped out. The total loss on that trade was 6.1% from entry. We shorted at 180, stopped out at 191 or 191 or 190, 190. Yeah, 191. I'm sorry. So 191 0.01 would be the stop, because any stop over 190, so that's or 191, sorry, getting all confused here. Either way, that's a 6.1% loss, but a beta adjusted loss of 5.5%. For those not familiar, because I do have this question put to me from time to time, what do you mean by beta adjustment? Keep in mind, on the site, anytime you see a dashed line below a term or a word or anything else, you hover on that and you'll get a pop-up. These are called tooltips. So in this case, T1 means first price profit target, T2 second price target, excuse me, and then suggested beta adjustment of 0.90. So when you hover over that, you see there. It just means reducing your position size to account for the expected volatility. Semiconductors are more volatile than, say, a Procter and Gamble or a, AT&T or something like that, any blue chip stocks. So therefore, you temper down your position. In this case, you take about a 10% reduction in an average position size. So therefore, that's where I refer to as a beta adjusted loss of 5.5%. But either way, the net loss 6.1. The profit target, had T2 been hit, would have been about a over 21% gain. So that's a very attractive risk reward. And again, that trade didn't pan out. Largely because the fact birds of a feather flock together. I knew that going in. Here's SOX, Semiconductor ETF, and I've harped for quite a while on these trend lines. This is what I'm watching until and unless these trend lines are broken, the uptrend in the semis is positive. Now, I knew that going in when we shorted. It looked like we might get a break of that trend line at the time. We had negative divergence, although that's not a sell signal. The sell signal will come on an impulsive break and close, or any break or a close below this trend line, ideally a close. And just from the look of this, and I've seen this many times in many securities, when you have these, I don't know, I want to use the right verbiage here. It's almost like an artificial ramp when you see the market just walk up day after day, low volume, with low volatility, and weeks. This has been, I don't know, a couple weeks now of consecutive green candles. Very, very often when I see that, I see this happen. a fade of almost that entire rally, and it usually comes with a bang. And I would put good money. We're going to see that soon. We saw it back here. You can see this, almost again. I won't call it an artificial ramp, but just it almost looks like that. Like the high frequency trading machines are just walking the semis higher, program trading, whatever, and then boom. In in this case, in 2 days, you wiped out weeks of the previous candles. I expect that to happen again. You can't bet on it. It's hard to see coming unless you can really identify it with the 60-minute charts. But I put pretty good odds that sooner than later, and it's all priced in here with these divergences and everything else. You're going to see in just a matter of days, you're going to see weeks and possibly months of the previous gains wiped out. You saw it here, right there, after that big bearish engulfing candle. And I think there's some others here on the left of the chart. Yep, you see an artificial looking ramp here, just that walking it up day after day after day, and then boom, you gave back, looks like two-thirds, at least two-thirds of that rally in very short order. Most of that came, you can see here on that one big red candle right here. So anyways, that's it. The trend is up and no reason to fight it now unless you get a sell signal. So that's where you need to live in the world of these intraday charts, 15, 60-minute charts. There's the socks on the 60-minute, and so you can get a heads up. There's a minor uptrend line. Probably look for some type of bearish reversal candlestick pattern or anything along those lines. SMH, these are the other ETFs. Same thing, divergent high. There's a primary uptrend line, and you need to see all three of these go. XSD is the only semi ETF until recently. We didn't have negative divergence, and now we have that. We now made an equal high right here to that high back in, looks like, what is that, June? Yeah, back in June. We now have negative divergence with the PPO and the RSI both making lower lows against prices making equal and or higher highs. So we can even push a little higher that divergence as long as that's intact. It's something to watch out for, trend reversal there. But again, no signals, sell signals now. Maybe we'll get some type of candlestick reversal pattern. But again, this is the big level here. Watching these, wait to see those go. Okay, for those who are bullish and think the semis will, continue to rally from here and want to look for any trading ops in there, um, Cirrus looks decent. I wouldn't personally take it, but I wanted to point that out for those that are bullish the semis. I'll tell you why here in a second. Well, I think I just made my case a minute ago about you know, any minute the ball can drop, and we're probably going to see a pretty swift reversal. A lot of hot air right now in the semis, but with that being said, here's a nice divergent low. You guys know I like to look for these divergent highs and lows. Cirrus had a divergent high, rising wedge, and from that divergent high, the stock has already dropped. Let me try to just go next to it. It's already fallen about 30%. So here's a semi well off its highs while the sector's making new highs. And it's at support. And this is what I like to do. I like to buy stocks that have fallen to support with bullish divergence in place. A couple things to note: that divergence, the trend is still bearish because we've crossed now that the PPO lines, both the signal line and the 9 EMA, or the PPO line and the signal line are below the zero line. However, that's negative divergence. It often comes from down there. So again, if you want to swing this one up, target would be up here. There's quite a bit. That was a key support level that was broken. That would be about a 10% gain to about 61.90, somewhere in there. Um, you look at the weekly chart, and what I see here, 10-year weekly chart, and this is another thing giving me pause. We had these two white lines were that's a rising wedge pattern and a very well-defined uptrend line there. Broken after that trend line broke, you can see the impulsive selling that helped to validate that trend line. That wedge pattern has not met its projected move. If you take the widest part of the wedge, which would be right here, and you add it to where the wedge broke down, that gives you a rough estimate of where we're going to go. So I can just tell you right now, this would be my target, 38.26, this horizontal line. Possibly a little higher, maybe down up towards this reaction high here. But and there's also potential uptrend line. Potential because it's only had a couple tags so far. So here's a yellow uptrend line to watch. I'm seeing on the weekly chart this PPO is now crossed down below the zero line for the first time in a while. That if that continues down and it doesn't prove to just be a whipsaw signal like this one, it's going to tell you right here, as it did here, that the trend is now bearish when that 9 EMA is below the zero line. And again, 10-year chart, the last time we had negative divergence on the weekly, you can see it right here in the PPO, clearly on the RSI, rising wedge. This is just a center line here. I can even delete that line. This was the wedge, breakdown back test, and that was good for a drop of about 60% on Cirrus. So that's the thing about these semis. There's just so much, the gains are so large during an uptrend, and the gains are very powerful and even faster because stocks tend to fall faster than they rise during a correction. So this one longer term still looks bearish, but again, the near term, as long as the semi sector is going up, this one probably has some catching up to do. Qualcomm's another one. Remember the semis corrected back a while back, and I had at the time, although I was bearish on the sector, I was bullish on Qualcomm. I even got some comments, hey, how can you be bearish on the semis? And that was this rising wedge here, and it broke. If I remember, we had the stop. We were clipped by pennies on the stop, but it went on to play out exactly as expected. It broke out. I think we tried to catch it here at support. That's what it was, and then it clipped the stop, but it went on to play out exactly to my second target. You can see that right there, and you have a downtrend line that formed since then. So now it broke out again. Had this downtrend line right here, and it had an even bigger divergent low. I know you guys see lines all over this chart. Let me just show you. So if I color code these, wrong line. Delete that one. Color code this to yellow, you'll see what I'm looking at, large rising wedge pattern and a breakout recently, very impulsive price action. Qualcomm used to be a darling in the semiconductor sector. They had their fallout with Apple a while back, and that really was a big part of that correction there. But that looks good. So, if I had to be long two semis right now, that would be it, Qualcomm and Cirrus. So trade them as you want. Okay, another sector that I'm bullish on right now, I've made mention quite a bit lately, is the consumer staples. While the market's trading at or near all-time highs, this one's well off the highs. These are staples, so even if there's a correction, you're not going to get killed in them. These are your Walmart, Procter& and Gamble, Coca-Cola, Philip Morris, Pepsi, all the blue chip names. And bottom line, it's there in the charts. There's a bullish divergent low. I like to trade divergent lows and highs. This chart says it all. Just look back here, negative divergence at this point right here, and that marked that top. You had a very nice correction that ended. You had positive divergence right here, and you had bullish divergence on the RSI at the low. That marked the rally. Negative divergence at the high. That marked the correction, and now we've come full circle. So it's really that simple, and it doesn't always have to play out, but I like to see divergent lows at support as well. And so far, this one's holding that support level. So again, if this is one of my favorite sectors right now, and it'll give you a nice little dividend, about 2.4%. And there's some individual stocks in there that look okay as well. Sector I'm not so hot about is the biotechs. This is a daily chart, negative divergence. You can see again, all the divergences are marked right here, and you can see corrections. And this is the third divergent high we've had in the last 2 years on this chart. So that's it on the daily chart, and I've already covered this on the 60-minute chart. We have a divergent high here on the 60-minute chart. Gave up that 87.88 support level. We're back testing it now, so there's another objective entry, but you got to watch this. You can certainly short here. We're starting to roll over. We do have the 1333 going slightly red right now. I can't tell. I'd really have to zoom in to see if that PPO signal line is crossed over. That would be confirmation that the trend is now flipped to bearish. So I'm watching for, you can see the trend has been bullish since right here. And that zero line often acts as support when tested from above. So watch for a move down there. A couple things, a reversal off this level, which I expect, and then you see these trend indicators slip bearish, and that would be, XBI looks good for a swing trade down to at least that 85-ish level, 84.75. I don't know exactly where it is right now. Maybe all the way down here, possibly more, again, when you look at that daily chart. All right, we'll wrap up with the broad markets. I've covered these, in detail yesterday. So nothing's changed at all. Yesterday I mentioned this is a level I'm watching on SPY, 253.87. Want to see a 60-minute close and/or impulsive breakdown below. Talked about that little whipsaw signal or stick save where we closed above it. So that's the level to watch on SPY. potentially bring us down to maybe this or this potential trend line. There's only two reactions. Maybe get a third, validate that trend line, a little bounce, maybe a kickback rally to that level, and then a move down here, ultimately to about 250.26 or so. That's SPY, and you want to see QQQ go as well. Q's put in a divergent high on the 60 minute, had a little kickback rally, or we're having a kickback rally now, but we're still off that high. And you can see the negative divergence there. Trend indicators are still bullish. And then the one to me that looks like it has the most meat on the bone now, but again, no sell signal yet. We had an early sell signal with the break of this wedge, but this has been the level that I'm watching, 149.42. You can see how well, just like SPY, it's dancing along this support. It has horizontal support here since the breakdown. It also had a stick save, just like SPY. You can see a beautiful stick save there, meaning the candle intra-period went down below that level but managed to close right back above it. So that level needs to go. Now, if you want to put the odds in your favor, if you're looking for a quick pullback trade on IWM or any of these, you want to see the large caps break too. Small caps can certainly drop if the large caps are going up, but it's going to give a little headwinds to that trade, any short trade. But if you see SPY and break that support level I just mentioned, QQQ rollover, and IWM break and have an impulsive move or a close below 149.42 on a 60-minute basis, that will most likely bring us down to this trend line. Like I talked about already, something like this, bounce, and maybe a move all the way down here to about 145. But again, no break of support, no sell signal. This is what we need to see. I'll wrap up here with just the longer term. I've been living in the world of the intraday charts lately, especially in the broad markets, because there has been virtually no volatility. We've been walking up. There's been a nice rally in the small caps, but it's been just a steady climb, one of those, high frequency trading, program trading driven market ramps. But the bigger picture is this is just another divergent high. Again, freeze this video. Look at all these divergent highs. They were all followed by corrections, even this last one back here. So they do play out for corrections. If you're even just right now, like I said, I'm just looking for a pullback trade. But these are the longer term charts. They have bigger, more significance than those 60-minute charts. So if we break here, you have support all the way down here, probably that previous reaction high somewhere around there. But you have big divergences in place. And the most overbought reading that we've seen in IWM and the small caps in years. I think it might have been over a decade or more. I covered that recently. So there's the big picture, at least the daily chart on IWM. We look at the weekly. Well, here's the weekly. This spans a decade now. We're looking at 10 years of price history. So what do we see? Go back to 2010, even throughout this bull market. Forget about the previous bear market. We've had three divergent highs in the last decade. This one right here was followed by a 30% correction. We had a divergent high here, it was followed by a 27% correction. Now we've come full circle. Once again, we have a divergent high. You can see it there. PPO, and the PPO is starting to turn down now. It hasn't made a bearish cross. That divergence is what I call potential. When the PPO makes a bearish cross, in other words, when this orange line crosses over that white line, down below the signal line, and effectively puts in a lower high, then we have confirmed divergence. The RSI IWM needs to turn down soon, or the RSI will not have negative divergence because we're right now making equal highs. You still have divergence when you have an indicator making equal or lower highs as long as price is making higher highs, which it is here. And you can see we had a ever so slight close above that primary uptrend line right there. So really, the big picture, what I see here is I see a primary uptrend line broken and being back tested. We overshot it, but let's see how we close in the next week or two here. And again, it all stacks, if you will. It all starts with that 60-minute chart. If that plays out for that pullback and we break that support and we drop even, a few percentage points, IWM, we close a week below, we're going to have a red candle back below this uptrend line. And then that will be we'll end up calling that a back test of the trend line. And then how do we go from there? Again, these are weekly charts. Can't get too excited. We just have to take it week by week and see how it plays out. Back here we had a breakdown here, back tested for a while and went on. And, even after the final back test of the trend line, we still made another marginal new high. But the market from there fell 27%. So Again, I just wanted to point it out. It's there in the charts. So, you know, same with SPY. It's a weekly chart of the SPY. Negative divergence. You can see it clear when I zoom in here. But you're above trend. This is the uptrend line. So until and unless that trend line goes, let's tighten that up, clean that up a little bit. But we're not far above it. And that's the thing about when prices start wedging here. Let me clean up this upper trend line too. This is really the divergence. This is really the wedge right here. So when prices start wedging, um, and price compression, you get that price compression, volatility. You can just in one bad week you can smash down through this trend line. But until then, the trend is up, and it could be up for a long time. These divergences can extend. Keep in mind, so we can continue higher, and until and unless the PPO takes out that previous reaction high and the RSI takes out that previous reaction high, there's room for these divergences to grow, and this could go on for months, or it could end next week. You just have to watch it. So again, long-term charts, nothing to really focus on now. If I see any developments there, I'll let you know. When we zoom down to a daily chart, here's your daily uptrend line. So what I'm talking about here is this tight little price compression. And let me just try to gauge it for you here. If I grab where we're at today and I measure down to where that trend line is, straight below 2.39%. That is technically speaking just one bad day in the SPY. We haven't seen that in a while because we don't have any volatility lately. But you can see it. Here's a period right there where the SPY fell 1.5%. It does happen, and it can happen. We're just a few bad days, so something to keep in mind. QQQ, same story. Divergent high series. You can go back, screenshot this, look at all these corrections, measure them out on your own if you want. I didn't write the percentage drops here, but again, that's it. Negative divergence, and this is why I don't chase a lot of longs here. The trend is high. If you're a trend follower, sure, take some long side breakouts, trail your stops up, you'll do well. And again, I have a list of about half a dozen longs that I'll go over and maybe put some of those out as official trade ideas. All right, let's wrap it up here. This has been long enough. This has been Randy Finney with Right Side of the Chart. And just remember in these videos, you can always go down to the settings and increase the playback speed. I find it best at the 1.25 setting, increases it by 25%, and you can still catch everything. And you can always, again, just pause the video or turn that speed setting back to normal, and it'll really cut the playback time down on these videos. Have a great day.